I'm Carrie Stamp with Carrie Stamp & Company, and I'm talking today about what we would refer to as old age insurance. This is designed for people that feel a little bit apprehensive that they might run out of money in retirement, or the purchasing power of the money that they saved for retirement may not be as much as it is 20 or 30 years from now as it is today. So, one of the strategies that we use is called a Qualified Longevity Annuity Contract. And if you're familiar with our practice, you will generally know that we tend to avoid annuity type products unless there is a very good reason for using annuity products. But a QLAC, or a Qualified Longevity Annuity product, can have some significant benefits for people that have concerns about running out of money. So, what is it? A QLAC is a contract with an insurance company, meaning that you need to make sure that the company that you're dealing with is going to be in business when you're going to need access to your money. The funds that go into a QLAC have to come from your IRA account. They have to come from a qualified IRA account, and they can be a maximum of $200,000. Now that's going to be adjusted for inflation under the new rules, and in Secure 2.0, the new Retirement Income Act, they eliminated the requirement that only 25% of your account could go into a QLAC, meaning that if you have a bunch of money saved up and it's not in an IRA, but you just want to use your IRA for longevity insurance, you could put most or a significant portion of your IRA into a QLAC to give you income at a future retirement date. Now, why would you want to do this? A few reasons. Number one, it will reduce the required minimum distributions on IRA accounts. Most folks know that at age 73, which has recently been bumped, you need to start taking distributions from your IRA whether you want to or not. If you take this money and put it in a QLAC, those funds are segregated and you don't need to calculate the amount of the RMD on the funds that are in the QLAC. That can have the significant impact of reducing your taxes in retirement and giving you more spendable money. The other thing that you can do with QLACs is you can defer the distributions to an age that you set in the future. You can choose to defer the distribution from these funds to age 75, age 80, age 85, or some number in between there. If you do that, you're going to get a payout, and the longer you defer it, the more that payout is going to be. So for example, we recently showed a 70-year-old client of ours what it would impact them if they deferred $200,000 until they were 85 years old. Well, if this client defers until age 85, the $200,000, they'll get a check for about $62,000 a year. These rates change all the time, every single day, and they are based on interest rates. So when you go to do this, it may or may not be exactly these figures. But if this particular client lives 3.5 years, they will more than get back what they put into the contract. Now that doesn't account necessarily for any interest. But if this gentleman lives to the same age of his father at age 96, then he will get close to $700,000 back from that qualified longevity annuity contract that he only put $200,000 into. So there can be some significant upside to doing this if you think you're going to live a long time. You can also ladder these contracts. So if you need an increase in your paycheck in retirement because you are worried about inflation, you can have one QLAC that starts at age 75, another one that starts at age 80, and another one that starts at age 85. They just can't exceed the $200,000 limit, but you can periodically give yourself a boost in your paycheck. Now, one thing to keep in mind, these contracts are not particularly flexible. Once you set them, there are two ways that you get out of them. Number one, you start drawing the income from them. And when you start drawing the income from them and you pass away, the income stops. The other way that you get out of them is that should you die before the age that the QLAC is supposed to start, almost every contract will give you a death benefit of returning the money to you that you put into the contract. That'll go back into your IRA and can be distributed back and out to your heirs or your spouse or whoever is going to get your IRA proceeds. So, if you're worried about running out of money, you want an increase in your paycheck in retirement, this is one strategy that you can take a look at. I'm Carrie Stamp. I'm a certified financial planner. I'm also a retirement income certified professional at Carrie Stamp & Company. If we can help you or answer any questions, feel free to give us a call. This has been a Principled Wealth Moment.